So let's talk about the SP 500 and the 200-day moving average. So it's so important to trade with an understanding of how important the 200-day moving average is. And the reason why I say that is that the 200-day moving average is like the mother of all moving averages. It is like the moving average's moving average. It's the big deal. It's what a lot of people consider the difference between a bull market and a bear market. So you have to consider the importance of the 200-day moving average when a stock or an ETF, even more so, begins testing or flirting with that area. And going back to February, we've been playing with the 200-day moving average for quite some time now. So we need to respect it. We need to see what it means for the market going forward. And what I want to do is I want to talk about a short trade recently that I had that I actually covered today. But the reason why it's so important is because my decision to get out of it hinged largely on what the 200-day moving average was doing and what the price action was doing on that stock as well, or actually in this case, the S&P 500. So I'm in SDS, and I'm going to pull up the 5-minute chart for you guys so you can see what I'm talking about here. So I short SDS. Actually, I'm long SDS, but SDS, for those who don't know, is a 2x ETF that provides an inverse return of the S&P 500. So if the S&P 500 goes up 1%, SDS goes down 2. If S&P 500 goes down 2%, SDS goes up 4%. So SDS is what I'm in. I'm actually long, but for the sake of making this entire video pretty simple, I'm just going to talk about shorting SPY here because that's essentially what SDS does. So I short SPY when I get this candle right over here. This candle here on the 5-minute bar, I short that. It pops up a little bit, but it doesn't, do anything in terms of major harm to the chart. And then it just goes on this like huge sell-off the rest of the day. I'm looking at about 3.5% worth of profits going into the close. You get a little bit of a double bottom here. It tries to break out, but it gets quickly squashed. So no biggie there. The next morning, it opens up and it just completely sells off about 20, 25 points or so, I believe. And so it looks like we may have another day like the previous day. The price action was kind of similar to it, where it initially starts higher and then it just comes right back down. But what started unfolding and what caught my eye was this price pattern, this basing pattern that forms a inverse head and shoulders pattern. Now, inverse head and shoulders pattern is kind of like a human silhouette upside down of a shoulder, a head, and then another shoulder. And so once it got to this point here, that's when I got out of it, and for good reason. So I get out of it. I collect about 3.25% on that trade. It's good. But why did I know to get out then? Because what ended up happening thereafter was a rally that put in nice higher highs and higher lows thereafter. So you have a nice strong channel. So the two things, the two main reasons why I got out of my trade was this inverse head and shoulders pattern that I talked about. Once it broke out, I decided I need to go ahead and break off that trade and go ahead and go cash as a whole. And then the other thing is on the daily chart, and this is the most important thing, the 200-day moving average was being played there and it wasn't breaking. I actually thought we probably would break the 200-day moving average simply because we broke it back earlier this month. And the more you test a support level, the more likely that support level is going to eventually break. So if you keep tapping it, it's kind of like glass. If you just keep pounding it, over time, it may not break the first time, but eventually if you just keep that consistent pressure on it, it's going to break. And that's kind of like the same thing with moving averages. If you keep putting the pressure on it, it's going to break eventually. So this SPY here, I thought there was a good chance, since we did break it temporarily for 1 or 2 days, that we would break it again here and possibly test this moving average or this support level way down lower here. So you have a support level that I thought we'd probably break this moving average and eventually test it here, but we didn't. And while we may still do that in the future, we're not doing it right now. And we held the 200-day moving average. I can't tell you how important that is, because so many algorithms and so many black box trading systems puts a huge emphasis on the 200-day moving average. So you have to respect it. And here, another perfect case. We tested it just like we tested it back in February. And even though it was pretty sloppy here in April, ultimately that 200-day moving average did hold and rallied higher. Now, the one thing I would say as well to keep an eye on is the fact that these rallies off the 200-day moving average are becoming weaker and weaker. So you had an initial rally, off the February lows that took SPY up to about the 280 range, and then we came back down, tested it, but then we only go up to the 270 range. So call me crazy, but I'm a little bit skeptical about whether or not we're going to have a very strong move thereafter. But for the purposes of my short on the SPY, I'm not going to hold it and let those gains just slip away, because right now you have the futures that are up overnight right now, and then you also have a good solid bounce. I mean, everything is saying bounce, bounce, bounce right now. Whether or not it can go on for 1 or 2 days, I don't know, or even if it can make it through tomorrow, I don't know. But take the profits and move on, because on that particular short position they had, because the 200-day moving average did hold, and the 200-day moving average is important in trading. It's something that you have to respect, whether or not you subscribe to technical analysis or not. There's a history of support that tends to show up when a stock or an ETF tests the 200-day moving average. So that's what I did here, and hope that you can learn from it and apply it to your own trading.